Hello and welcome to BQ Prime. I'm in conversation with Kalpen Parekh, CEO and MD of DSP Mutual Fund. So thank you so much for taking time out for us today.
Thank you.
So, at this point, looking at rich market valuations, how do you kind of strike a balance? And what are the sectors that you are looking at this point?
In markets, valuations keep fluctuating, and as an investor, my time horizons are generally very long term, and so is what we expect of all our investors who come in equity as an asset class. Over a long period of time, generally, valuations don't really make that much of an impact. But however, if you are an investor with a shorter time horizon, then of course valuations do play a role. So at this point in time in the market, our recommendation or advice would be to stagger investments through SIPs. So in an SIP, what happens is only 10% of money gets deployed in current valuations, because SIPs are over a 10-year period, 120 months. So today's valuations have very low bearing on the overall cycle of investing. Or alternatively, if one asset class is richly valued, which is, let's say, equity right now, you could add some flavor of two or three other asset classes into your portfolio, whether it is global stocks or bonds or even precious metals, because they have not, relative to equity, gone up as much in the last 5 or 10 years. So that's so I don't generally get worried about valuations. And as I say, they keep fluctuating. From a sector perspective, if you see most of our portfolios, they have fairly large weights in banks, in few banks, because banks are showing reasonably steady growth versus the last cycle, improved balance sheets, very high quality of balance sheets versus what we have seen 5 or 10 years back, and relative valuations to their own history, which were expensive, they have moderated. They are at fairly priced. Nothing is cheap right now. The second sector where over the last 1 year we had increased our exposure, and we were perhaps a bit early, was healthcare and pharma stocks. Just to give an example, the sector has 3 to 4% weight in benchmarks. Our portfolios had between 8% to 14% weight, so meaningfully overweight. And that seems to have worked well in the last month, where a lot of pharma stocks have run up. Auto is another sector where we have been overweight, because from a business cycle point of view, a lot of auto companies are showing volume growth almost after 4 or 5 years, or even 8-10 years. So broadly, these are three sectors where we have been overweight at large in our portfolios.
I do want to ask you a little bit more about the small cap space, the kind of run up we've seen so far. What's your outlook going forward?
See, we always start by looking at companies, their cash flows, their profitability, and their valuations, and we don't start from the lens of market cap. Overall, the small cap index has run up. No doubt, small cap stocks also have run up in small cap funds, and we do see a bit of caution required in that bucket. Having said that, in our portfolios, whether it is small cap or our mid cap funds, which are our two large flagship funds, there are enough companies which are in a low cycle of their business, because of which some of these stocks have actually not run up in the last 2 or 3 years. In fact, some of them have seen price correction. I spoke about healthcare, for example. So some of our stocks over the last 2-3 years were actually trending downwards, and only in the last few months they have started to move. So in our small cap portfolio, broadly, we are very comfortable with the choice of our companies. They are either stocks which have not run up extensively, or they are businesses which are now improving their operating metrics. They were having margin pressure, volume pressure. That is bottoming out now. So we are comfortable. Mid caps, again, we do see some froth, and hence, even if you go to our website, where the first message is, for long-term wealth creation in small caps, you need long-term. Don't expect it in short periods of time, and start an SIP. So our recommendation is invest via SIPs. And I always tell people that, between choosing small cap stocks directly, where you are not discerning enough in terms of the quality of these small cap companies, it's better to do it through small cap mutual funds, because all small cap fund managers, whether DSP or otherwise, they play a very important role in filtering or eliminating out weaker quality businesses. So in recent times, area of worry in the small cap universe is not so much small cap funds, but a lot of frothy companies, or companies which are running up on stories and narratives, and not real cash flows. So when Chandrayaan happened, a lot of stocks which had just some connection or the other with space or exploration suddenly ran up. But So that type of investing could be harmful. But if you invest through, good fund houses and fund managers, they'll be far more prudent in building the portfolio.
Okay. So, as a fund house, just looking at markets the past year, have you warmed up a little bit more to B2G companies, public companies?
What B2G? I didn't understand.
So, those supplying to the government.
Again, I think that's not the way we look at building a portfolio. Our starting point is very well documented on our website for every portfolio that we have, every fund that we have. Our starting point is companies should have either very high ROEs, or their journey from low to high ROE should be evident. Our starting point is these companies should be having steady cash flows. They should be paying out consistent dividends year on year. They should be rewarding shareholders, and they should be available at reasonable valuations. If companies supplying to government end up being a part of this universe, so be it. But we don't use that as our starting point to build our portfolios.
All right. We've seen a slew of regulatory changes the past year. So, as a mutual fund house, what's the impact been like?
I think, we are very blessed. I have my sister and cousins who live outside, and I tell them that, over the last 10 years, a lot of regulatory changes have made the mutual fund far more transparent, far more easy for the consumer to either understand or transact or access. And each of these regulatory changes are only making the industry safer from a consumer point of view. Their hard-earned money is managed in a far more safer and prudent way. And that also in a way is reflecting in the growth of the industry over the last 4 or 5 years. And I think that is a very positive tailwind for us as an industry.
Sure. So, looking at the current market levels and looking at the balance one is striving to strike between optimism and valuations, what's what's your midterm picture looking like? I mean, what's your expectation? What can go wrong?
Okay, so I've been in the fund industry since 98, 25 years. And every day I've been either confused or slightly worried at all points in time. There are phases of euphoria, there are phases of anxiety, but generally I have always felt cautious at all points in time, and especially when markets rise very sharply, which is happening right now. At large, what governs us is the long-term picture, because we are here to manage long-term money for our investors. And the long-term picture is, over the last 25 years we've seen, and I think that will continue even in decades ahead, is India offers great opportunities in terms of good companies which are progressing very well, which are managed very well, which generate superior return on capital. And if investors stay invested with them for long periods of time, they will create wealth. So I don't want to distract investors in their journey of long term by giving short-term anxiety. And every 2 years markets fluctuate by 15%. It's part of the game. You should not be worried about that. What are few points which can be temporarily negative right now could be, if the rise in interest rates globally, which has happened since last 18 months, if that continues for longer, somewhere it will start affecting flows into emerging market and India. It could affect valuations, which are now, becoming richer and richer, as you highlighted. Near term, oil prices have been rising, though oil has become less of a worry for India in the last cycle, because its contribution in terms of our overall imports or GDP has gradually started coming down as the size of our GDP also rises. But if oil rises sharply further from here, it again can have temporary impact on our macro situation, on our currency, and hence on flows, and can create volatility. Generally, when markets are expensive, something or the other comes in as a point of volatility, and which is why we only have 2 points to recommend: that either see through this volatility by not looking at it and ignore it, because people who have money for next 10 years, next 1 year, what's going to happen is irrelevant, it's immaterial. Or for new money, invest via hybrid funds or asset allocation funds, which will have lesser volatility. So if your portfolio has other asset classes which shield equity from its volatility, investors become immune, and that volatility does not really affect them.
All right. Thank you so much. Stay tuned to BQ Prime. BQ Prime. BQ Prime. BQ Prime. BQ Prime. BQ Prime.